Welcome to the Deep Dive. We're the place where we take all that complex info, sift through it, and give you the clear, actionable insights you actually need. Think of us as your shortcut to being genuinely in the know.
That's the goal.
Today, we're plunging into the story of SNDL Inc. You'll find them on the NASDAQ, ticker SNDL. Now, I bet for some of you, that name rings a bell, maybe as a past meme stock from that wilder market era.
Yeah, it definitely had that phase.
Exactly. So the big question is, has SNDL really moved past that speculative history? Has it become this durable, cash-generating machine built on this kind of unlikely mix of cannabis and liquor? Or is this recent profitability, which, let's be clear, was hard-won, is it just, a blip, a temporary illusion in what everyone knows is a super challenging market?
That's the core tension, isn't it?
It is. We're going to dive deep into the data, look at analyst price targets, and really explore what it all means for this, well, pretty intriguing company. You might actually find some surprising facts here, things that challenge maybe what you thought you knew, and reveal some potential upside the market might be overlooking.
Yeah, we've really done a comprehensive expert-level analysis here, dug into all the financials, market metrics, qualitative stuff, and just so everyone's clear, all our data, all our insights are current as of August 29th, 2025. That's when the stock closed at the $2.68 per share. We're going to unpack their unique business model, the management's track record, which is quite something, and importantly, their financial resilience in a very volatile industry.
Okay, great. And to keep things clear, we've split this deep dive into two parts. First up, part one, we'll tackle their fundamentals. We'll start with chapter one, business analysis. Then we'll move to chapter two, management evaluation, and wrap up part one with chapter three, financial analysis. Then, in part two, we'll cover chapter four, market sentiment, chapter five, ownership structure, chapter six, risk assessment, and finally, chapter seven, conclusion.
Sounds like a plan.
We'll announce each chapter clearly as we go. All right, let's get into it. Okay, kicking things off with chapter one, business analysis. So when you first look at SNDL, their core business model is, it's unique. It's this diversified structure built around regulated consumer products, think liquor and cannabis, and also strategic investments.
Yeah, it's split into three main parts. You've got liquor retail, then cannabis, both retail and operations, and finally the investments arm.
Right. And this structure feels pretty deliberate, like a strategy for stability.
Absolutely. And what really jumps out first is the liquor retail segment. I mean, this thing is the bedrock of the whole company. It's their largest and, frankly, most stable revenue generator. They're actually Canada's largest private sector liquor retailer.
The largest. Wow.
Yeah, largest. Operating about 165 locations. You'll know the names. Wine and Beyond, Liquor Depot, Ace Liquor.
No.
Familiar brands.
Exactly. And just in Q2 2025, that segment brought in nearly $142 million in net revenue. So it really provides this solid, stable foundation for everything else they're doing.
That steady liquor income is a massive differentiator, isn't it? Okay, but let's shift gears to the cannabis segment. This is where you see their vertical integration really playing out.
Right.
On the retail side, again, they're huge. One of Canada's largest private cannabis retailers.
Yeah.
Something like 184 stores under Value Buds and Spirit Leaf.
Yeah, and they hit a record there, too, in Q2 25. See, $84.4 million net revenue. Quite impressive growth.
It is. And then you have the cannabis operations side. This covers everything from cultivation, manufacturing, distribution, all under their own brands like Sundial, Top Leaf, Palmetto, Grasslands. And a really key strategic move here, I think, was acquiring Indiva. That positions them to really dominate the edibles category, which is growing fast.
That was smart. And they're even starting to get traction internationally, about $3.8 million in Q2 25 from international sales. It's small, but growing. It's interesting. Okay, what about the third leg of the stool, the investments segment?
Right, so this is basically their strategic capital arm. It operates mainly through a joint venture called Sunstream Bancorp Inc. They invest across the broader North American cannabis industry, looking for opportunities and generating income from interest and fees on those investments.
So like a venture capital fund inside the company?
Kind of, yeah, and it's substantial. As of June 30th, 2025, that portfolio had a carrying value of over $400 million. It's a serious part of the business.
So putting it all together, SNDL's market position and scale is pretty formidable. Canada's largest private liquor retailer, one of the largest private cannabis retailers, over 349 locations in total.
That scale gives them enormous market access, buying power, and crucially, a ton of consumer data.
Which leads to their primary value proposition, right?
Exactly. For consumers, it's pretty straightforward. Convenience, accessibility, value, especially with brands like Value Buds. But for investors, SNDL offers something quite unique. It's like a de-risked way to get exposure to the Canadian regulated products market.
De-risked how?
By combining the stability of liquor with the higher growth potential of cannabis.
Yeah.
And the whole thing is underpinned by that amazing debt-free balance sheet we keep mentioning.
Okay, let's broaden out now to the industry analysis. Starting with market trends, what's happening in Canadian cannabis overall?
Well, the legal market is projected to grow pretty healthily. About 12% compound annual growth rate expected between 2025 and 2030. And over 70% of cannabis consumption is now coming from legal sources, which is a big shift.
Right, legal market is definitely taking over. Any specific product trends?
Yeah, we're seeing growth in convenient formats. Pre-rolls, edibles are really popular.
Okay, and how does SNDL fit into that?
This is where it gets interesting. SNDL's cannabis business. It's growing nearly 3 times faster than the overall market.
Wow, 3 times.
Yeah, they are aggressively taking market share.
But the competitive landscape must be brutal, right?
Oh, it's intense. Absolutely. Significant price deflation, lots of players. You've got Tilray, Canopy Growth, Aurora Canopy.
Big names.
Big names. And High Tide, too, where, interestingly, SNDL owns an 8.2% stake.
A stake in a competitor. Strategic.
Very. But this hyper-competition is exactly where SNDL's diversified model and that rock-solid balance sheet become a huge strategic advantage. It's like a war of attrition out there, and they have the resources.
Makes sense. And then there's the regulatory environment. Always complicated in cannabis.
Always. You've got the Federal Cannabis Act, but then the provinces control distribution and retail, often in different ways.
That's fragmented.
Very. But models like Alberta's, more privatized,
Right.
actually benefit experienced operators like SNDL. Still, they have to navigate strict rules like that 10 milligram THC limit on edibles.
And barriers to entry. Still high.
Definitely. Rigorous licensing, huge capital needed, hard to get economies of scale, the market's consolidating, clearly favoring the larger, well-funded players.
So, wrapping up this chapter, what's SNDL's core competitive advantage? Their moat.
It's a combination, really. Strong brands, massive scale Value Buds, Spirit Leaf, wine, and beyond. Vertical integration helps too, controlling the chain. But the absolute key, it's that fortress balance sheet. Oversee $208 million in cash, zero debt.
Zero debt. That's huge.
It's virtually unmatched in this sector. It gives them resilience, flexibility, the ability to make acquisitions when others can't. It's a massive advantage.
Okay, that's a fantastic picture of the business itself. Let's transition now into Chapter 2, management evaluation. Because a company, especially one that's turned around like this, often comes down to its leadership. What's the story with the team running SNDL?
Yeah, this is really the core of the turnaround narrative. You have to talk about the CEO, Zachary George. He came in January 2020, right when the company was, frankly, facing existential threats. Massive debt, inefficiency, bankruptcy was a real possibility.
So he walked into a crisis.
A major crisis.
Yeah.
And his tenure has just been defined by this methodical, sometimes painful, but ultimately successful transformation.
When you say painful, what did they have to do?
Well, his crisis response is critical to understanding their mindset now. Back in June 2020, he implemented what he called a painful but necessary solution. We're talking asset sales, debt for equity swaps, tough moves that literally saved the company from bankruptcy.
Wow.
And they haven't stopped. Even if we're hitting profitability, just last year, July 2024, they did another restructuring. Cut $20 million in annualized corporate overhead.
So constant focus on efficiency.
Exactly. This history means the current team was like forged in fire. It instilled this deep fiscal discipline and rigorous risk management. It's just part of their DNA now.
That kind of track record builds confidence. What about their communication, transparency, and ethical reputation? Does it match that disciplined approach?
It seems to. They maintain pretty high standards. Their financial results are detailed. And CEO Zachary George's commentary is consistently direct. It's candid, data-supported. He focuses on real metrics like same-store sales, gross margin expansion. And they're upfront about challenges, too, like volatility in their investment portfolio.
Any red flags ethically?
No major ethical scandals reported, which in this industry is actually quite notable. It points to integrity.
Okay, so let's connect this discipline to capital allocation. That's always a key driver of long-term value. How are they deploying their capital?
Well, they're clearly committed to both organic growth, building from within, and inorganic growth, meaning acquisitions. We saw about $9.5 million in capital spending for new stores in Q2 25. So they are investing in the core business.
But the M&A strategy seems to have been really transformative.
Oh, absolutely. It's reshaped the entire company. These weren't small deals.
Can you give us the highlights? The big ones?
Sure. Think about Elkanah Inc. That brought in the whole liquor pillar basically overnight.
Right, the liquor stores.
Yeah, exactly. Then you have the Valens Company and Spiritleaf Holdings. Those significantly boosted their cannabis production and retail footprint.
Okay.
Acquiring Indiva made them a leader in edibles. And more recently, there's a pending deal for a company called 1CM Inc. That's another 32 cannabis stores for about $62 million cash.
Wow, still acquiring.
And don't forget that strategic 8.2% stake in their competitor, High Tide. These moves were very deliberate, building scale and diversification.
That's an aggressive M&A playbook. What about returning capital to shareholders? Share buyback history and dividend policy.
Right, so no dividend, which honestly for a company still cementing its growth and profitability makes perfect sense. You reinvest.
But okay, buybacks?
They do have an active share buyback program. It was renewed last November for up to $100 million.
Yeah.
And they did buy back quite a few shares, nearly 11 million in late 24, early 25.
I sense a but.
Well, what's really insightful is that they bought back no shares in Q2 2025. Zero.
Why not?
Because that timing lines up exactly with the 1CM acquisition announcement. It shows management is clearly prioritizing strategic M&A when they see good opportunities, potentially offering better long-term returns than buybacks at that moment. It's pragmatic.
That's smart allocation. Okay, finally for this chapter, return on invested capital, ROIC. Historically, it wasn't great, right?
Correct. Historically negative. It was around minus 3.6% in Q1 2025.
But things are changing.
Yes. Q2 2025 marked their first ever quarter of positive operating income. That is a huge inflection point. Mathematically, it means ROIC is set to turn positive and start improving. It's a major milestone, showing they're starting to deploy capital more efficiently.
A powerful turnaround story indeed. Okay, let's get into the nitty-gritty now with Chapter 3, Financial Analysis. Let's hit the key numbers.
All right, key metrics review. As of that August 29th date, market cap was around $690 million USD. Now, revenue growth trends over the last 5 years. Story is explosive growth, and this is a big, but it's largely been driven by acquisitions.
Right. We saw that M&A activity. So what are the actual numbers?
Okay, 2023 revenue was about $909 million. 2024 edged up slightly to $920.5 million, so only about 1.3% growth year over year then. But if you look at the trailing 12 months, the TTM, as of Q2 2025, revenue hit $944.3 million. That's a bit better, about 3.5% growth.
Wait, so growth is happening, but maybe slowing slightly on the surface if you strip out new deals.
Potentially, yeah. And it's critical to layer this against the stock performance. Over 5 years, the stock is down almost 29%. Ouch. Why? That reflects the market penalizing the company for all the dilution that happened during the turnaround, plus the years of unprofitability alongside that acquisition-fueled growth.
Got it. But now, the narrative shift. Profit margins. This is where things get interesting, right? A dramatic positive turn.
Absolutely dramatic. Let's break it down. Gross margin, strongly improving. TTM is over 27%, but Q2 2025 hit a record high of 27.6%. That's a 2.1 percentage point jump year over year. Very strong.
Okay, good start. Operating margin.
This is the big one.
Okay.
Operating margin, TTM was still negative 1.18%. But Q2 2025, positive $5.0 million for the first time ever.
First time ever. That's huge.
It's a major turnaround signal. And the same story for net profit margin. TTM was negative, over negative 10%. But Q2 2025, positive net income of $2.88 million.
Wow, so black ink, finally.
Black ink. These Q2 figures really signal a fundamental operational shift. It's not just acquisitions anymore. The underlying business is becoming profitable.
That's incredibly significant. Okay, what about free cash flow generation? Cannabis companies often struggle here.
Historically, SNDL did too. From 2019 to 2023, they consistently burned cash. Negative free cash flow every year.
Okay.
But 2024, their first full year of positive free cash flow, they generated $34 million.
Another turnaround point. What about Q2 25? Was that positive too?
Actually, Q2 25 was slightly negative, about minus $8 million, but management explained this. They attributed it to seasonal factors, building up working capital for international growth, some annual payments hitting.
So a temporary dip?
That's the explanation. And crucially, their guidance for the full year 2024 remains positive free cash flow. So they expect this to reverse.
Okay, let's talk financial stability. Are these positive earnings consistent now or just a one-off good quarter?
Well, historically, earnings were all over the place, mostly negative, but Q1 and Q2 of 2025 both beat analyst EPS estimates. And that Q2 beat was significant, a positive EPS of 0.01 cents versus expectations of a $1.04 loss. That's tangible evidence the turnaround is gaining traction and predictability.
And the debt-to-equity ratio. You mentioned the fortress balance sheet.
It really is a fortress. As of June 30th, 2025, they are effectively debt-free. Total liabilities around $205 million are just dwarfed by $1.3 billion in assets and $1.1 billion in shareholder equity.
So the ratio is near zero.
Pretty much near zero. It was over 2.0 back in 2020, a massive improvement. Their current ratio is also exceptionally strong at over 5, meaning tons of liquidity to cover short-term bills.
And just to confirm, dividend stability and growth still not applicable.
Correct. No dividend paid. Focuses on reinvestment and M&A.
All right, let's wrap up the financials with valuation analysis. Starting with relative valuation, how does SNDL look next to its peers?
Okay, price to earnings, PE, isn't very useful yet because of those negative TTM earnings. Price to sales, PS, is 1.04. That stacks up okay against Tilray at 1.50, but it's higher than High Tide at 0.78.
But the interesting one is price to book.
Exactly. Price to book PB compares market value to the company's net asset value on paper. SNDL's PB is 0.87.
Below 1.0.
Right, which is a classic indicator value investors look for. It suggests the market might be valuing the company at less than its tangible assets, indicating potential undervaluation.
That definitely catches the eye. Okay, what about intrinsic valuation? Trying to figure out what it's really worth. DCF models are tough here.
Very tough, super sensitive to assumptions in this volatile sector. So let's lean on analyst consensus here. The average 12-month price target from analysts is $3.75. The range they give is $3 to $4.50.
So that's our analyst-derived intrinsic value range.
Let's call it that. And just understand the implied assumptions behind those targets. Usually sustained revenue growth, maybe around 5% a year, significant improvement in free cash flow margins, and likely a high discount rate, 12–15%, because of that industry risk.
Okay, we've covered the business, management, and the hard numbers. That brings us to Chapter 4, Market Sentiment. How is the market actually feeling about SNDL right now?
It's a really interesting mix, actually. Let's start with analyst price targets and consensus rating. As we just said, that average 12-month target is $3.75. From the current price of $2.68, that implies a pretty significant upside, almost 40%.
39.4% upside potential? That sounds bullish. So is the consensus a strong buy?
Well, this is the fascinating part. Despite that implied upside, the overall consensus rating is actually a cautious hold. The average brokerage recommendation score is 2.00, right in the middle.
Hold. Why the disconnect? Upside potential, but hold.
It suggests analysts see the value, they see the turnaround, but they're still wary. Wary of the industry risks competition, regulation, and probably SNDL's own past volatility. It feels like a prove-it-to-me stance.
Okay, that makes sense. What about the general buzz, recent news impact, and general media tone? Has that shifted?
Oh, definitely. The news flow lately has been overwhelmingly positive, especially around that Q2 2025 profitability news. The narrative has really moved on from speculative meme stock to, a legitimate turnaround story. You see headlines now highlighting SNDL starting to stand out among Canadian cannabis players. The perception is changing.
Good to hear. Let's look at some market indicators. What's the short interest telling us? Are people betting against it?
Not really. Short interest as a percentage of float is very low. Only about 3 million shares held short, which is just 1.35% of the float.
So low bearish bets.
Exactly. Generally seen as a bullish signal. Sophisticated investors aren't heavily betting against it.
Okay. What about technicals? Moving averages?
Looking positive there, too.
Yeah.
The share price, $2.68, is comfortably above its 50-day simple moving average, which was around $2.44. That suggests positive short to medium-term momentum.
And the longer-term trend, the 200-day?
Also strong. The price is well above its 200-day SMA of $1.95. That signals a pretty established long-term uptrend is in place.
Now, here's where it gets really interesting, right? Didn't something significant happen on the charts recently?
Yes, the golden cross.
Yeah.
This happened recently. The 50-day SMA crossed above the 200-day SMA.
And for people who follow charts?
That's widely seen by technical analysts as a significant bullish signal, often interpreted as potentially indicating the start of a sustained, longer-term uptrend. So technically, the picture looks quite strong right now.
Very interesting technical setup. Okay, let's shift focus now to Chapter 5, Ownership Structure. Who actually owns SNDL? Let's start with stakeholder analysis. Institutions.
Right. We see about 152 institutional holders. They own roughly 42 million shares, which works out to about 16.4% of the company. And there's a definite bullish tilt in recent activity. As of June 30th, 2025, 60 institutions increased their positions compared to only 49 decreasing.
Any big names adding shares?
Yes, significant increases were seen from Millennium Management and also the Royal Bank of Canada. Show some growing institutional confidence.
Can you list the top 5 institutional holders, just so people know the big players?
Sure. The top 5 are Cannell Capital LLC, Tidal Investments LLC, BNP Paribas Financial Markets, Morgan Stanley, and Millennium Management LLC.
Okay. Now, what about the insiders, insider holdings, and recent transactions? What are the folks running the company doing with their own money?
Insiders, as a group, own about 1.32% of the company, not a huge percentage overall. CEO Zachary George holds the most, over 1.7 million shares, which is about 0.67% of the company. That's worth roughly $4.6 million.
Okay, 1.32% isn't massive. Is there anything more revealing there?
Yes. This is what's really fascinating. If you look at the pattern of transactions over the past year, you see consistent open market purchases by company directors. People like Gregory Turnbull, James Cannell, Brian Pinney.
Buying shares on the open market.
Oh, exactly. And crucially, during that same period, there have been no corresponding open market sales by insiders.
No selling, only buying.
Right. That's a very powerful signal. The people who know the company best are putting their own money in and not taking any out. Suggests strong belief in the future and maybe that the stock is undervalued.
That is a strong signal. Okay, last point here. Ownership concentration. Is ownership spread out, or is there a risk of a few big players having too much influence?
It's relatively diffuse, actually. The general public holds the majority, about 71%. Institutions and hedge funds hold around 27.7%. The top 25 shareholders combined own about 27.5% of the company. That concentration level isn't really high enough to pose a significant risk of, undue influence over corporate governance. Seems like a healthy spread.
All right. We have a really solid understanding of the business, the management, the financials, the market view, and ownership. Now it's time for the reality check. Chapter 6, risk assessment. Let's break it down with a SWOT analysis. Strengths, weaknesses, opportunities, threats.
Makes sense.
Yeah.
Let's start with the strengths, internal competencies. We've hit these, but let's recap. Number 1 has to be that financial fortress, the debt-free balance sheet, oversee $208 million cash. Huge strength.
Absolutely.
Second, market leadership and scale. Being the largest private liquor retailer, top tier in cannabis, that gives them clout. Third, diversified revenue streams. That blend of stable liquor and high-growth cannabis provides balance. And fourth, proven turnaround management, a team that's navigated crisis successfully.
Okay, those are solid internal strengths. Now for the flip side, weaknesses, internal limitations. What holds them back?
Well, despite recent success, that history of unprofitability still casts a shadow. They absolutely must prove this newfound profitability is sustainable, not just a blip.
Okay, consistency is key.
Right. Second, there's still a heavy reliance on M&A for growth. They need to show they can generate consistent organic growth from the businesses they bought, not just keep buying more scale.
Integrate and grow from within.
Exactly. And third, while insiders are buying, that overall low insider ownership, just 1.3%, might be seen by some investors as maybe not ideal alignment, although the buying trend helps offset that concern.
Got it. Okay, let's look outward now. Opportunities, future market potential. Where could SNDL go from here?
Big opportunities, I think. First, Canadian market consolidation. With their balance sheet, they're perfectly positioned to scoop up struggling competitors, likely at good prices.
Be the consolidator.
Precisely. Second, international expansion. They've already started generating revenue from Europe and Australia with medical cannabis. That could grow significantly.
Okay.
Third, the big one, U.S. market potential. Management has explicitly started a strategic review for U.S. entry. Could be a listing change, could be waiting for federal reform, but it's on the radar.
That would be a game changer.
Huge. And finally, just continued margin expansion through realizing more synergies from their acquisitions and ongoing operational efficiencies.
Lots of potential upside. But there are always threats, general external challenges lurking. What are the big ones for SNDL?
Number 1 is just the intense competition in Canadian cannabis. It's a saturated market, fierce price pressure that constantly threatens profitability for everyone.
Hard to escape that.
Very hard. Second, regulatory risk. The rules are always evolving. Taxation, marketing restrictions, product formats. Things can change quickly and impact the business.
Always a factor in regulated industries.
Always. And third, don't forget the illicit market competition. The black market is still a persistent competitor, especially on price, and offering products that are maybe outside the legal limits.
Right, the unregulated side. Okay, let's connect this SWOT to the broader economy. Impact of key macroeconomic factors. How does something like inflation affect SNDL?
Well, it's a mixed bag. Cannabis prices themselves have actually been deflationary, going down.
Yeah.
But general inflation on operating costs, labor, logistics, supplies that could definitely squeeze their margins if they can't pass those costs on.
Okay, so a cost pressure. What about interest rates? They're high right now.
Now this is where SNDL has a fascinating strategic advantage. As a debt-free company, higher interest rates don't hurt them directly at all. They aren't borrowing.
Right, they're insulated.
Exactly. But high rates put huge strain on their competitors who are carrying debt. It eats into their profits, makes them weaker, and potentially makes them more affordable acquisition targets for cash-rich SNDL.
Wow, so higher rates actually help their M&A strategy.
It turns an industry headwind into a powerful tailwind for their consolidation plans. It's a significant advantage.
That's a brilliant point. Lastly, impact of specific geopolitical factors. There were those 35% U.S. tariffs on some Canadian goods announced August 1st. Any impact on SNDL?
Yeah, we looked at that. The direct impact on SNDL's current business, it's minimal to basically non-existent.
Why is that?
Because their operations are almost entirely in Canada, and their current exports go mainly to Europe and Australia, not the U.S.
Yeah.
The risk from those tariffs would only really materialize if and when SNDL actually starts exporting products to the U.S. market. It's a future risk, perhaps, but not a current one.
Okay, fantastic analysis. We have covered so much ground. It's time to bring it all together in Chapter 7. Conclusion. Let's start with a synthesis of findings. Can you lay out the bull case for us?
Sure. The bull case for SNDL really rests on several strong pillars. First, undeniably, that fortress balance sheet. Massive cash, zero debt. Gives them incredible flexibility and safety.
Pillar 1, the balance sheet.
Pillar 2, proven turnaround leadership. This management team successfully navigated from near death to profitability. They've shown they can execute.
Okay.
Pillar 3, dominant market position. Leader in Canadian liquor, top tier in cannabis. That scale provides real advantages.
Scale matters.
Pillar 4, compelling valuation. Trading below tangible book value, that PB of 0.87 suggests potential undervaluation.
Right, the value angle.
And pillar 5, positive operational and technical momentum. Margins are expanding, they're gaining market share, and the technical chart patterns like that golden cross look bullish.
That's a strong set of arguments. But we need balance. What's the bear case? Why might someone be hesitant?
Okay, the bear case highlights the undeniable challenges. First, it's still a hyper-competitive industry. Oversupply, brutal price wars, that's a constant threat to profitability for everyone involved.
The industry risk.
Exactly. Second, it's still arguably an unproven organic growth engine. Most of the growth came from buying things. They still need to consistently show they can grow the core business organically.
Show me the organic growth.
Right. Third, complex integration risks. Managing these diverse segments, liquor, cannabis retail, cultivation, investments, it's operationally complex. Synergies take time and aren't guaranteed.
Complexity is a risk.
And fourth, those persistent regulatory headwinds. The cannabis industry rules keep changing. Taxes, marketing, product rules. It's an uncertain landscape.
So summarizing the valuation again, where did the analysts land?
Based on those Wall Street estimates, the intrinsic value range for SNDL Inc. seems to be somewhere between $3 and $4.50 per share.
Okay. So what's the final word? The concluding outlook.
Well, as of that late August date, SNDL's share price was $2.68. That's trading below the low end of that analyst-derived value range.
Below the range. Okay.
Which strongly suggests the market may not be fully appreciating or crediting the company for the successful turnaround, its dominant market positions, and that incredibly strong balance sheet.
Yeah.
There appears to be a disconnect. But you absolutely must weigh that apparent undervaluation against the very real, significant, and persistent risks of operating in the Canadian cannabis industry. It's hyper-competitive, heavily regulated. So the story is, the company has successfully navigated its internal crisis. The big question now is, can it consistently thrive and execute in this very challenging external environment? That's what the market is watching.
Wow. What an incredible deep dive. SNDL Inc. A company that really has transformed itself from the edge of collapse to being debt-free, profitable with major positions in both liquor and cannabis. It's quite the comeback story.
It really is. The management turnaround, the balance sheet straight, it's genuinely compelling stuff. But, those industry challenges, the competition, the regulations, they're absolutely not trivial.
Yeah.
You can't ignore them.
So true. So what does this all mean for you listening? You see the analyst targets suggesting significant upside, right? But the consensus is still hold. What is the market waiting for? More proof, more consistency. How do you weigh that proven management team and their strategic wins against the undeniable challenge of generating consistent organic growth in this tough market? Definitely something to mull over. Maybe discuss it next time you're browsing the aisles at a Wine and Beyond or Ace Liquor. Okay, before we officially wrap up, if you found this deep dive valuable, and we hope you did, please remember to like this video and subscribe to the Stock Analytics AI YouTube channel. We've got a great offer for members. For just €4.99 a month, you get priority deep dives on specific tickers you request. We're actually planning to cover all of the S&P 500 stocks over the next few months, and members get exclusive priority access to those.
Yeah, it's a great way to get analysis on the stocks you care about most.
And if you just want a one-off deep dive on a specific stock that's caught your eye, you can always drop us a super thanks right here on the video.
And now for the very important quick reminder. This analysis was generated by an AI system. It's for educational and informational purposes only. It should absolutely not be considered financial advice. Always, always conduct your own thorough research, or better yet, consult with a qualified financial advisor before making any investment decisions.
Excellent point. Thanks again for diving deep with us today. We look forward to our next exploration.